Kitco News Outlook 2024 is brought to you by iTrustCapital. Buy and sell crypto, gold, and silver with your IRA.
Hey everyone, I'm Jeremy Szafron. Thanks again for joining us today. And as we approach the end of 2023, the equity markets are displaying a remarkable rally with investor sentiment high. And as you can see here, we've also entered the extreme greed sentiment on the Fear and Greed Index. Now, this surge is driven by a combination of factors. There's expectations of moderation in the Fed's interest rate hikes. There's also signs of easing inflation, and there's advancements in technology, particularly around AI. However, this wave of optimism raises questions about the sustainability of this rally, especially considering the underlying economic uncertainties that lie ahead. Now, as we look towards in 2024 with potential shifts in market dynamics and a focus on quality investments, we're witnessing a strategic pivot in investor behavior. Joining us today to dissect these trends and provide insights into what lies ahead is Phillip Streible, Chief Market Strategist at BlueLine Futures. Hey, Phil, thanks for being with us today.
Yeah, thanks for having me, Jeremy.
You know, it's an interesting time, as I mentioned in the intro here, and it doesn't really look like this is just a Santa Claus rally. So is this here to stay?
Yeah, it seems like, it really feels like we're going to continue to march on. I mean, stocks are really looking at the prospects of these rate cuts, the soft landing, and we're really below some of these all-time highs. So that's where I really think there's room to run. Small caps are 20% below their 2021 highs. NASDAQ still about 8% below its all-time highs. And I really think that investors right now are scrambling to cover a lot of their shorts and they're redeploying cash.
Yeah, you know, it's interesting. And as an analyst, what are some of the key indicators that you're currently monitoring that you think will play a pivotal role in shaping equity markets as we enter into the new year in 2024 here?
Well, if you look at the way inflation's played out, I mean, current CPI levels are about 3.1. And if you look at those COVID highs, that was about 9.1. So we've come down quite a bit. We're still above that Fed's long-term 2% goal. But if you look at many of the economic indicators that have come out, you know, they have been much stronger, especially on the labor market. That's been one of the toughest sectors to break here. I think that everyone's out there really just trying to work as hard as they can, try and get ahead because their debt levels have been rising. But I really think with, headline inflation coming down, we're seeing that break in the energy prices now, a small uptick as we're doing this recording because of some renewed conflict in the Middle East. But the way prices really sold off towards the end of the session, it seems like people are not really concerned about any kind of, uptick on energy prices impacting inflation.
Yeah, we saw Jay Powell kind of do a little bit of a pivot last week. We were all kind of surprised by that analysis. And it almost seemed as though some people from the Fed are coming out this weekend and really trying to calm the storm a little bit. And I'm curious, given your focus on the indicators that you just mentioned, are there any that you believe are being overlooked in this market?
Well, when you say with Jay Powell, with a lot of these Fed members coming and backing up, okay, we've seen quite a bit of economic indicators, provide that kind of indication that the Fed should cut the dot plot and everything. I do believe that they think that the higher for longer theme will allow them to achieve their long-term goals. So they are really backpedaling and scrambling to undo these talks that, the Fed is going to ultimately cut rates in March. Now, if you look like about a month ago, there was expectations that the Fed was going to continue to raise rates right into January, and there were only two price cuts that were factored in for 2024. Now you've got the three interest rate cuts and you have no additional interest rate hikes. So the only markets that we've seen it really impact is like the gold markets come down and it lost some of that upward trajectory because of the fact on the backpedaling. But it's all the people that are locked in from over the summer. You probably got these phone calls where people were like, Jeremy, how can I get 5% on my money? How do I get an I-bond? What kind of short duration, risk-free asset is going to give me that 5% yielding? So everyone parked their money in those liquid money market funds. Now, if you look at November, you get a 7% increase in U.S. equities. One of stellar months out there. People are going, man, I could have made that 5% that's annualized over a year within 1 month. Now they're redeploying the capital. Now they're getting things going, and they're really looking at things like small cap, which tend to outperform when you have an interest rate cut cycle.
Yeah, and as investors look for guidance in this market, what are the key strategies that you would advise investors to adopt in order to, as you mentioned, capitalize on the rally, but mitigate risk a little bit?
Yeah, well, I think you do have to you got to peer back. If you had that traditional 60-40 portfolio, you're getting some of that money back. We've seen yields come off quite a bit. The 10-year treasury yield finally dipped back below 4%. You got to get the duration right. You got to be in shorter term duration because that's where the yield curve is going to steepen more. I still like that Magnificent Seven. A few of them are stalling out, but it's really important to align where you do have some commodities in there. You do have some short-term put exposure, and that's what we do over at BlueLine Capital. We try and structure portfolios where we incorporate some degree of commodities in there. There's been a lot that have been outperforming and a lot that are set up to do well in 2024. You get the green energy, you're going to see silver prices go up. You've already seen uranium start to pick up. Energy, you want to be kind of avoiding at the moment other than these small little blips here and there. But if you're at all concerned on things, you could always take 1% to 2% of your portfolio, look at some longer term put options to protect you on any kind of downdraft.
Yeah, it's interesting. And I mean, there hasn't been a ton of downdraft as we've seen so far, but how do you distinguish between short-lived market trends and these sustainable long-term investment opportunities, particularly now?
Well, it seems like we've gotten a lot of the things behind us, a lot of these uncertainties, like, the Fed continuing to raise rates. The pivot is definitely here right now. And it seems like there's going to be no additional interest rate hikes. We've got a lot of downturns that are going on over in Europe and other countries out there. They're starting to slow down. So I would cut off the international exposures, stay more domesticated, within the U.S. Because of the fact I think that our economy is going to outperform a bit better than others. But as far as the sustainability of this, we really think that it's there. The only uncertainty is that the realization that the Fed is making these cuts or is pricing in these cuts and willing to accept it. Do they see something that we are not seeing at the moment? That's the only question that lies out there.
Yeah, and has any of this data, we've seen some really interesting data, has any of it particularly really surprised you or caught you off guard, like many analysts this month?
I thought it was the labor market. The labor was the most important one. We saw that uptick, 199,000 jobs versus 180 created. We saw the unemployment rate, continue to tick down. So it's the resiliency in the labor market. Retail sales has been good. We do have a lot of data coming out this week, very heavy on the residential side. We've got real estate data releases, everything from housing starts, new home sales, existing home sales, that personal income and personal spending. We'll see if that will moderate just a bit, and that would align with what the Fed's hoping to achieve. But I really think now with interest rates coming down from 8% to like 6.5% now, that might spark a little bit of interest in the housing market.
Yeah, we had a guest on last week, Peter Berezin, and he was talking about equities particularly doing well for about 6 to 8 months, and then maybe a little bit of a crash here. Do you see any effects of this, or is this more of a short-term hold strategy?
Well, it depends on how the Fed does play out the interest rate cuts. If they come out with insurance cuts where, we saw when they were rising, they were only expected 25 basis points. They end up going up to 50 basis points. What if they do that on the downside? So in March, all of a sudden, you get a 25 basis point cut. You come to June and you get a 50 basis point cut. Well, that's going to throw things. That's going to have a lot of people, I think, running a bit for the door on some of these markets because there might be some concerns that are happening there, whether it's another slowdown in GDP or, corporate earnings, things like that. But we just don't see it at the moment. There's no reason to deviate from that long strategy. I think on the S&P 500, a reasonable target of 5,000 to 5,100, is fairly likely. That back half in 2024, when you get to the last quarter, I think that's just a little bit too far to look out. Maybe if you got something globally, like an escalation on the geopolitics, that could play a role. All of a sudden, more confrontation between US and China. But generally speaking, when you have an election year, the market tends to perform well in the first half, and then it kind of paces out as you get into the election. And after that, we'll see what happens, because the two politicians that are running have greatly different agendas out there, and it could send the market one way or another.
Yeah, it's going to be fascinating covering this year as well. Let's talk a little bit about your favorite. Let's talk about commodities, the wider commodities market here, especially gold and silver. I mean, what are your thoughts on the current trends? Obviously, we saw gold reach an all-time high this past, just a few weeks ago. What's driving it? Where are we going? And where's the retail market positioning themselves here?
2162, that was that contract high. It happened on a Sunday night. I always tell people Sunday nights are for harvesting profits, trimming back positions, not reestablishing new ones. So you get one of these explosive moves. There's a lot of fear in the market, a lot of FOMO. Market takes off to the upside. And what happens is those people that bought the top, they're $120 an ounce, against them. So it's going to be tough for them to make that money back here. We only saw a couple contracts trade at that high, so hopefully they got the firepower to add and bring things down. But much of it comes from this recent sell-off, and this kind of headwind that we're having is because of the fact that the Fed is pushing back. And it's been numerous Fed officials that are saying that they had not even discussed, interest rate cuts whatsoever, that the higher for longer theme could pertain. So you're seeing a rotation out where people jumped into gold. Now they're kind of coming out. They're chasing those U.S. equities like we talked about. I wouldn't be surprised if we don't see, if we do get some kind of escalation in the Middle East, we don't see oil prices go up. But something today when we saw oil up 3-4% at one point, gold prices were not really, they weren't reacting well at all. They were very contained. The near-term resistance on gold, 2050, just above that, it's going to be that 2065 level. If we can close above that, we're probably going to start to attack the 21 in that all-time high. But I think your major level of support on gold is going to be right around from 2000 down to 1990. I think there's a lot of pocket support, a lot of people that are looking at, hey, gold is a great asset class to own in an interest rate cut environment. If you could buy some kind of correction and, we end up getting these cuts, that's where you get the tailwinds on gold.
Yeah, absolutely. And, given the historic performance of gold, do you see a similar trajectory here for silver?
The thing with silver, so in order to get the gasoline on the fire of the silver market, you do need gold taken off to the upside. You do need the weaker dollar, but you need China behind it because it's an industrial metal. 54% of silver's uses are industrial. So if you could see China getting some kind of concrete footing on, their declining property sector, get deflation behind them, get that economy reinvigorated. We've seen some little green shoots here and there over in China, and that's how you got the volatility that's in the copper market. But if you get that going, that's where you could see silver break out. Your resistance points on silver are really this $26, $27. You can't even think about $30 unless you get the interest rate cuts, you get gold going up, you get China behind it. On the support side, I think you add a little bit at the 23, 22, and 21 level. It feels like inflation has risen the price of silver, where we're not going to see silver in the teens, at least anytime soon, not bearing some new pandemic. But silver, where it's at right now, $24, I'm not overly excited on adding contracts there. I think you need to be closer to those low 23s. And one other thing that I usually use to kind of keep me in check on whether I should be having more exposure to silver or gold is the gold silver ratio. And it's really just been kind of hovering between 80 on the downside, 86 on the upside. And we sit here at 84, kind of in no man's land. So that's how I play it.
Yeah. What do you think? What's going to make us break out here? What is that event that we're looking for?
You got to have that. You need to have insurance cuts. You need to have the Federal Reserve cut more than 25 basis points. You have to have China really get, things going over there, some kind of stimulus to the upside that gets their market. Their equity market is reached like 5-year lows. I mean, it's just crashing. There's nothing going on of any kind of, positivity in the Chinese economy. So that's got to be the first thing that really goes. And then you'll start to see these momentum moves to the upside in the silver market.
Yeah, it's fascinating, even as we watch China buy up gold in their central banks as well.
Yeah, they have been. I mean, silver is not one that they hold up in central banks. It's just too large. I mean, I don't know if you've seen, a 1,000-ounce bar is going to be 60 pounds. That's a lot of silver, if you're going to have it in any kind of massive quantity. But the ETF demand, that's something else that needs to come back. We saw it there going into that Sunday night, but as quick as it came is as quick as it went. And just like crude oil futures right now, coming into last week, it was at the 97th percentile of, the maximum amount of short. Seems like everyone is short oil. You get some kind of event, you get the 3 to 4% move. So, what's going to drive people in there? I think that as soon as you see money market funds, that liquidation go on, equities get a little bit too high, you're going to see people looking at putting their assets to work in markets like gold, silver, copper, platinum, things like that, just holding some hard assets for that safety.
Phillip Streible, doing what he does best. Thanks for joining us and sharing your invaluable insights today. And of course, we look forward to having you on next year.
Oh, thanks for having me.
Thanks, Phil. And thanks again for watching Kitco News. I'm Jeremy Szafron. Don't forget to check out our app for the latest and subscribe to our YouTube channel. We'll see you next time.
Kitco News Outlook 2024 is brought to you by iTrustCapital. Buy and sell crypto, gold, and silver with your IRA.